Hello grasshoppers, welcome back to the channel. I'm Marcus D. Today I want to talk to you about averages. You may or may not have heard about ATR. It stands for average true range. More experienced traders use it for stop sizing based on volatility across whatever period or time frame you're looking at. ADR, average daily range, is similar. Now, I've always had a bit of an issue with ATR because I frequently trade through multiple sessions. So if I'm basing my stops on a session that is outside of the regular trading hours, those stops will be very tiny and they very likely won't survive the volatility of the regular trading hours. But when it comes to that particular problem, I found a solution. Instead of ATR on a lower time frame, I will look at ADR, which is calculated over the entire 24-hour period going back some 10 to 14 days. But I'm also an intraday trader, so I took that old school concept of scaling stops and actually used it for something else. I created actual dynamic intraday levels that the price interacts with. And why does it matter that we know where ADR is on the day as a level? It's because on most days, 92% of the days to be exact, price will stay contained in that range. Before I go on, I do need to sort out one of my main food groups, caffeine. Now, what is ADR and how do you calculate it? So the simple version is that you take the high to low across, let's say, 10 to 14 days, you average that out. That number tells you the typical distance that this particular product moves in a single day, statistically. To start that calculation, I divide it in half, and then I plot it as a beginner upper boundary, ADR high, and the lower boundary, ADR low. But this calculation only begins when the new candle starts to print. Now, my ADR levels represent quantitative extremes. They're also dynamic because they will move with each new day's high or new day's low until one side is then exceeded or exhausted. At that point, if you have our Blahtech DR indicator already, that exhausted side becomes static, but the other one can still move until that one is exhausted to the opposite side as well. Those two lines, two boundaries, are your expected range for the day. Now, I went further and I actually created an average session range, ASR, which does the same calculation, but it does it for either regular trading hours or any active current exchange. This is very useful if you're trading something with distinct session characteristics. For example, I trade a lot of metals, so metals have a very particular behavior during Tokyo, then also during London, and then finally for their official regular trading hours, COMEX. So what can happen at these levels? So you can obviously trade to them. Price can slow down, churn sideways, so run out of steam, maybe overshoots them a little bit and then reclaims them. But usually, if you're expecting a normal day with no outliers, it can actually give you a fade, a reversal, so pretty clean reversals as well. So they can act as a ceiling, they can act as a floor, and a lot of the times they can act as a magnet, pulling the price towards that level. Now, can price blow through them? Yes, absolutely. And some days you get that genuine trend day where the price just keeps going, seemingly no pullbacks, nothing, just one directional price discovery that takes no prisoners. Now, if you've ever seen some of these trades of mine that go either to the ADR or from the ADR, you may be wondering why do the ADR levels work so well. It's because these levels are not random, they are statistical quantitative extremes, boundaries based on what sort of a range this product usually does. And here's the beautiful thing about them. These extremes aren't always connected to the previous structure, like previous day high, previous day low. They exist independently of that. Even if you're at an all-time high with no other references, but you still have that range left on the day, that's actually a very, very good stopping point or reversal point if you want to fade the move. And my dogs are going absolutely bonkers in the background. Now that I have my face on, let's get into the office. Strategy number 1, trade towards the extreme. This one is for early to mid session. So instead of guessing how far this thing will run for, you will target the ADR high or ADR low depending on the direction, because you already know the probable destination. It's plotted on your chart. So you get on board with the trend, minding those inside highs and lows, and then let it cruise to the edge of that range. That's your first trade done. You don't overstay. You don't get greedy hoping it becomes one of those 8% outlier days. These levels give you a logical exit that isn't based on hope. And this is why breakout trading right into those levels after you've already gone so far on the day, it's not the best thing. And this is why breakout traders who don't know this little piece of data, they will almost always lose. The second strategy is to fade the extreme. This one is for a later part of the session. Let's say you caught it earlier and price has been grinding all day. It finally tags and maybe even overshoots ADR high. It usually takes hours to get there. And this is where the retail crowd gets it exactly backwards. They see the price break some arbitrary level, go straight into the ADR high, but they don't know that, right? And they think, breakout, I'm in, let's chase it. Unfortunately, most times this will fail. So what you should do instead is to wait for the reversal clues if you're already up at ADR high, or to close your position, take your profit. What you're expecting to see at this point is at the very least that the price stalls at the extreme. Maybe it throws a false breakout above it, but then it comes back under, prints a clean reversal candle, at least on a 15-minute time frame. At that point, you have the entry for the fade of the move. What will be your target? It'll be halfway back into that range. Maybe a little bit more if you're trading commodities that have a downside bias. But what's really important about this approach is that you're not predicting the reversal. You're not picking the tops or the bottoms. You're confirming that the breakout failed at the quantitative extreme, and now you're expecting the fade. So you will be on the right side of the market. ADR highs will frequently also have confluences with levels from the options chain. Like let's say a strike price that has a lot of open interest attached to it. At that point, you will usually expect dealers to hedge at those levels, so you have the market makers on your side as well. Before I go into the final strategy, the dogs really need to be walked, so let's go and do that. Quick muddy head count: 7, Rimmer, Breaded, Crichton, Bond, Leonard, Astrid. Yes! That was fresh. Where was I? Alright, the final strategy, the outlier setup. Sometimes ADR isn't a boundary. On a handful of days, it's just a waypoint, especially in the markets that have a tendency to trend hard. And here's how you would identify those outlier days. Let's take metals, for example. Price breaks ADR high, ideally quite early. If the price is already trended above the Asia range, that adds confluence to the trending day. As we all know, maybe we don't, but you'll find out, Asian session tends to be the one that begins the price discovery, which is why Asia high and Asia low tend to be really important reference points across the board, but more so in the metals. So when this break of ADR happens and the price never reclaims ADR but instead starts moving away further from it with increasing volume, you're probably looking at an outlier day, which has already ignored the statistical extreme. So this indicates institutional flow and other time frame participants that are doing position trading. This is something real, driving it beyond the normal rotational behavior. So this is the time when you don't fade. This is when you stay in with the trend and add to it. ADR getting ignored by itself can be a strong signal, right? But when you combine this with the Asia range break and the sustained movement above that range, that's one of the best filters for genuine trending days versus a normal rotation. Now, how do you get these levels? Well, you could mess around with the Excel spreadsheet, but of course we still have our Blahtech DR indicator that plots these for you automatically and tracks them. It has all the fancy stuff in it, but it is still at this time only on MetaTrader 5 via AMP Futures, which many of you dislike, even though it's just like logic, regardless of the platform that runs it. But we actually decided to create a Blahtech Discord utility server. We post these levels for 12 different markets at this time, multiple times a day. Target high, target low, ADR range and ASR levels for all 3 major sessions. Alongside the ADR and ASR levels, we also post market profile levels at Tokyo Open, London Open, and the relevant COMEX, NYMEX, or New York Stock Exchange. So now you don't have to go scrambling and losing your head in spreadsheet formulas. Now you can pick up the level from our utility Discord and place them wherever you want, whichever platform you wish. A simple line on the chart, just like I do every morning for my Top Step TV show. The average session range levels are my twist on the whole ADR as a level concept. Using just regular trading hours or any active exchange that we currently have across those previous 10 days. So not the full ETH, not the full overnight data, just the relevant session. And how do you obtain these? To make things simple for everybody, I've created new YouTube memberships. The first step is that you will need to connect your Discord account with your YouTube account. After you've done this, go ahead and pick one of the options from the YouTube memberships. If you click join, you will get another video, which is pretty short, but it explains all of this a little bit better. Now for a more cost-effective version, if you only trade equities, we have Blahtech equities levels. If you only trade metals, we have a membership for that too. As well as the energies markets, but you also have the option to get all currently supported products, which is 12 of them. To find out more, like I said, just click the join button where you will watch a video explaining all of this before you decide. And that's it. 3 strategies. Trade into the extremes as magnets, fade the extremes when price is showing reversal signals, ride the outlier day when ADR gets ignored. You'll stop chasing breakouts into these areas and you'll start to question the quality of the setup. The data tells you where the boundaries are. Most days, these boundaries will hold or get reclaimed after a bit of an overshoot. Now, if eventually the ADR gets ignored and you're breaking outside of the Asia session, you're looking into that outlier day, and then you can even use the former ADR level as a backtest to ride the new trend. If this was useful to you in any way, feel free to click subscribe, post a comment, ask a question. I always answer sensible comments, and also click on the notifications bell because I only post when I have something to share or value. That way you will know when I have a new video out. If you've made it to the end of the video, thank you so much for sharing your time with me. So let's all try to be less grasshopper and more market stalker with every passing day. Goodbye!